Imagine you and two friends start a cozy cafe. You agree, let's split the profits equally. Sounds simple, right? But wait, one of you invests 5 lakhs rupees, another works full-time managing the place, and the third often withdraws money for personal use. Now the real questions begin. Should the investor earn more? Should the working partner get a salary? And how do you record all those personal withdrawals? This is where things get interesting and where special aspects of partnership accounts come into play. In this video, we'll uncover the accounting rules that bring clarity and fairness to partnerships, especially when things aren't as equal as they seem. Now, you might be wondering, how is partnership accounting different from a sole proprietorship? Well, think of it like this. It's the same foundation, but with extra layers because more people means more complexity. Here are 5 key areas where special adjustments come into play. Capital accounts, how each partner's investment is tracked. Profit and loss distribution, who gets how much and why. Adjustments for past errors, fixing what was missed or done wrong. Reconstitution of the firm, what happens when someone joins or exits. Dissolution of the firm, the final chapter when the firm ends. In this video, we'll focus on the first 3, the ones that impact your everyday accounting and partner relationships the most. Let's talk about how each partner's investment is recorded through their capital account. There are 2 ways to maintain it. Fixed capital method. Here, the capital account remains, well, fixed. It only changes when capital is added or withdrawn. All other entries, like profits, interest, or drawings, are recorded in a separate current account. This method keeps things stable and crystal clear. Fluctuating capital method. This one's more dynamic. Each partner has just one account. Profits, drawings, interest, everything goes in here. As the name suggests, the balance fluctuates year to year. In a sole proprietorship, profits go straight to the owner. But in a partnership, it's not that simple. That's why we use the Profit and Loss Appropriation Account, a special account that tells us how to divide the firm's profit among the partners. Here's what it handles: interest on capital, reward for investing money. Interest on drawings, charge for using firm's money. Salaries and commissions for partners who manage operations. Let's say the firm earns 1 lakh. If the deed says a partner gets 5,000 salary and 10% interest on capital, these are deducted first. Only then is the remaining profit shared in the agreed ratio. It's fair, it's structured, and it's essential in partnership accounting. Let's meet Anu, Bina, and Dev, 3 partners in a business. Anu invests 10 lakhs, Bina brings in 5 lakhs, and Dev contributes just 2 lakhs, but works full-time managing day-to-day operations. Now here's the dilemma. Should Dev receive a salary for his effort? Should Anu get more profit for investing the most? If their partnership deed clearly mentions this, the accountant simply follows it. But if there's no deed, the Indian Partnership Act 1932 applies. And by default, profits are shared equally, no partner gets a salary, and no interest on capital is allowed. That's why knowing how to apply or adjust these rules isn't just technical, it's critical for fairness and clarity. Even with the best planning, mistakes happen. Sometimes, after finalizing the accounts, we realize something was missed. Maybe a partner's interest on capital wasn't recorded, or profits were split using the wrong ratio. But don't worry, we don't reopen the entire book. Instead, we use a profit and loss adjustment account to fix it. Example, partner A should have received 3,000 as interest on capital, but didn't. Partner B, meanwhile, got 1,500 more than they were entitled to. The solution? A single adjusting journal entry, credit A's account, debit B's, and the books are corrected. No mess. No rework. Just clean, fair accounting. These special adjustments are more than just numbers, they're what keep partnerships fair and functional. In a setup where money, time, and effort vary between partners, they answer critical questions like who deserves how much profit? What happens if a partner withdraws too much? And how do we fix something we forgot to record? Without these rules, trust would collapse, and so would the partnership. So, here's your quick takeaway. Capital accounts show what each partner brings in. Appropriation accounts decide how profits are shared. And adjustment entries fix anything we missed. In our next video, we'll dive into the how with journal entries, formats, and step-by-step examples. Don't miss it.